Very good afternoon, everyone. I, Dr. Jamaluddin Nasir, working as an assistant professor in the Department of Commerce, Integral University, Lucknow. Today, we are going to deliver a very healthy. We are going to deliver a very impactful lecture on working capital management and capital structure planning and its analysis. So, as I told you in my previous classes, that the management of the capital is one of the most important tasks for the business point of view. That what do you mean by these management and why the management of management of these uh, capital is important, have a significant role in business. So, if you remember well, in my previous lecture, I told you that the management of the capital is structured, capital budgeting, all these things we have successfully covered. So, based on this previous lecture, now understand capital working capital means a capital which is required for the smooth functioning of the business. A capital is required for the day-to-day business, and it's having importance is the if you have sound management of the capital, it means that the business organization will be flourish. It will be a smooth functioning of the business. If you are not sound in terms of your business, so ultimately it's going to affect your business. So we will discuss today that how to adopt a such kinds of sound technologies and practice for a smooth functioning of the business. So, similarly, second topic will be the capital structure. Under this planning and analysis we will discuss. So now understand first in this lecture we are planning to discuss with you all the some key points. The content of this lecture will be introduction to working capital management, defining working capital, importance of effective working capital management, cash conversion cycle, inventory management means how you're going to manage the inventory and why it have important concept. What about the account receivable, account payable management, financing working capital, optimizing working capital management, conclusion remarks on these working capital management. Then we will talk about the capital structured planning and analysis means what do you mean by capital structured, what do you understand by the capital structure, importance of capital structure planning, factor influencing capital structure decision, debt influencing debt financing sources and consideration, equity financing types and implications, optimum capital structure, balancing risk and return, capital structure analysis, financial issue and metrics, strategies for adjusting capital structure, and last we will discuss the concluding remarks on what we have discussed in our lectures. So this will be our presentation. The content of the presentation has already been given here and which has already been uh, on your screen. Right now is what currently reflecting displaying that what does it means of capital management and why have capital uh, working capital have important role in business, why have to management the investment, why do have management why do we have to manage account receivable, account payable, all these things we will discuss in these lectures. So we will starting first the capital. Just right now, as I told you, working capital is required for a smooth functioning of business. A day-to-day capital is required for the business purposes. So working capital management is a crucial aspect of a business financial health. It involves the efficient management of current assets and current liabilities. A number of items falling under the current assets and current liabilities to ensure the steady flow of cash and optimize operational efficiency. Effective working capital management enables businesses to meet their short-term obligations, invest in growth opportunities, and ultimately achieve the profitability. Under these lecture, we will provide a comprehensive overview of the key concepts, strategies, and best practices related to working capital management. So when we're talking about the working capital management, a management of the working capital, a smooth functioning of the business is possible only and only when we have a strong control on working capitals. And under the working capital, number of items fallen down, current assets, current liabilities, the management of current and current liabilities, current assets and current liabilities is known as what? The management of the current working capital. So how does working capital have been defined? First, now try to understand the working capital meaning. What do you mean by these working capitals? So, as per the definition, working capital, also known as net working capital, is also known as is the difference between company current assets and current liability. Simple in a nutshell, you can say is the difference between current assets and current liabilities is known as the working capital. It essentially represents the fund available for the day-to-day operation of a business. Current assets include cash, account receivable, inventory, and prepaid expenses. While on the other hand, current liabilities includes account payable, short-term loans, short-term loans, and accrued expenses. So current assets that can be converted into cash within a year is known as current assets. The simple definition of these current assets has been defined, has been given here, has been mentioned, has been defined. Quick conversion of assets into cash within a year, within an accounting period, within a period of 12 months is known as the current assets. Similarly, current liabilities, the financial obligations that are due within a year, the liability which you have to pay within a year is known as current liability. So the difference between current assets and current liabilities is known as the working capital. So what does it have importance? Why these capital working capital management have a very crucial aspect, very have a very significant role in the finance. So try to understand the importance of effective working capital management. If you have a very strong mechanism of control towards your liabilities, means if you have a strong, if you sound enough in managing your working capital, you will get advantages. So first is smooth operation. Effective working capital is essential for a business financial success, financial health. It allows businesses to achieve the following objectives. First is smooth operation. Ensure the sufficient fund for day-to-day operation and meet short-term obligations. Optimize resource allocation and reduce expenses, ultimately increasing the profitability. Once you have reduced your expenses and increasing your assets, generating your income, so it will be what? Leads to profitability of the business. And once profitability will be leads, it will lead to growth. Free up capital for investment in new project and expand the operation. Once you have a strong control towards your liabilities, and if you sound in terms of your policies and strategies to uh, boost your business. Once the profitability, once there will be saving in the capital, it will be what leads to diversification of your business. A new technology, a new project you can introduce is what called the growth. Financial stability, maintaining a strong financial position and minimize minimize the risk of liquidities. So the last importance of having effective working capital management, it ensures that the financial stability is sound financial position of your business is for smooth functioning of the business. So here, when we're talking about the working capital management, effective working capital management, if you have strong policies practices, so it will lead first smooth operation of the business, then operation profitability of the business, growth, of the business, and last, the financial stability, financial position, the financial health of the firm, financial health of the business, financial performance of the business. So, cash conversion cycle, as I told you, inventory purchase in order to the CCC, triple C, cash conversion cycle is a what matrix that measures the time it takes for a business to convert its investment in, in inventory and other resources into cash from sales. A shorter CCC indicates a more efficient use of working capital, leading to improved profitability. If a long CC triple C cash conversion cycle, it means you have a very uh, a very you are very you are not sound to use your capital, and what leading less profitability. Once in this cycle, first cycle, first step is what inventory purchase. The time from purchasing raw material to holding finished goods. Second step involves production, the time taken to manufacture goods from raw material. Third step in the cycle, triple C, cash flow, cash conversion cycle, involve sales, the time from selling goods to receiving payment from the customer. And the last stage in this cash conversion cycle, the time from receiving payment to having it available for use. So under these conversion cycles, we have just told you the four stages, means four steps under these CC triple C cash conversion cycles. That is a metric that measures the time taken for a business to convert its investment into inventory and other resources into cash from the sale. So once the goods has been purchased, it is converted into finished products. Its production process will be start. Once the goods is ready for the purpose of sell it out, once sales took place, it will generate more and more revenue. More sales, more revenue. No sales, no revenue. So, inventory management is the most important part under the management, under these working capital management. A sound and effective and a strong mechanism of controlling towards inventory leads business for optimum optimizing working capital. It involves striking a balance between having enough inventory to meet customer demands and minimize the cost associated with holding excessive inventory. And this can be achieved through number of techniques. For example, ABC analysis. Inventory turnover ratio has been prescribed for the same purpose. So just in time, inventory is received only when needed. The first method is what GIT, just in time. Inventory is received only when needed, minimizing the storage cost. If you purchase in a bulk the various materials you need to store it with a block of the capital will be going to block. Why? It is material is not required. So the first method in order to inventory management, just in time when it's required purchase. Second, ABC analysis talking about periodizing inventory based on value and importance, focusing on high value items. Means number A, place A, those who are having a very high rank goods, having high value for the purpose of manufacturing goods and less services. Similarly, B category also lay down some items, C category also lay down. So in ABC analysis will answered will enable you just periodizing the inventory, value based inventory and importance, focusing on high value items compared to least item. Similarly, inventory turnover ratio talk about the measuring the efficiency of inventory management by calculating how often inventory is sold and replenished. So these are the various, these are the three types of you know method has been prescribed for sound inventory management. Similarly, Account receivable management. Once the goods has been sold on credit, you should to businesses should to understand with at what time this is to receive. Means the management account receivable when once you have to call for your money. Means account receivable management focuses on minimizing the time it takes for customer to pay their invoices, maximizing cash flow. Effective strategic include credit policy. The first point under if you want for the sound management of accounts receivable, the first point every businesses needs to be consider credit policy. Credit policy talk about establishing clear credit terms and procedure to minimize the risk of bad debt. You should to be very clear in terms of your credit policy. Means businesses should to be very clear if you want to manage your account receivable soundly, effectively. Second point, invoice automation is streamlining the billing process to ensure the timely and accurate invoicing without any kinds of delay. Adopt AI for the purpose of what? For the purpose of streamlining the billing to ensure the timely and accurate invoicing. The third stage, in order to manage account receivable soundly, collection process. Implementing efficient procedure for follow-up on overdue payments. And last, aging analysis. Monitoring the average age of receivable to identify any potential issue, address or manage any kinds of controversy arises. If there will be any kinds of controversies, right, make it analysis, right, address all kinds of necessary issues in this. Similarly, you should to also be if you wanted to make a strong management of working capital. Under this working capital, what about the various categories of assets and liabilities fall into? Have to manage effectively and soundly. Have a strong strategies in order to manage all these things. So, in order to account payable management, if you have purchased goods on credit, make it timely payments. Make it early payment to get the discount. Account payable management involves optimizing the timing of the payments to supplier. This can lead to improved cash inflow and potential lower financial cost. The first point under the means in order to manage the account payable soundly, effectively, you should to keep first point in mind payment terms. Negotiate favorable payment terms with supplier, maximizing the payment period and potential earning discounts. Means there must be some terms and conditions for the payments of the purchased goods. Negotiate favorable payment terms with the supplier to whom you purchase the goods. Then early discount if they provide any kinds of discount, taking advantages of early payment discount offered by supplier reduce the cost of goods sold. If supplier offers you to make a lump sum payment and you'll get discount, make it so reducing the cost of goods sold. And the third step involved in this account payable management, automated payment system. Means implementing automated payment system to streamline the process and ensure timely payments. So these are some few points, keywords which you have to take into account for as effective account payable management. Similarly, financing working capital. There are a number of sources of finance available: internal, external, outsourced, abroad. When a business requires any additional fund to finance working capital needs, they can explore various finances options. Few has been pointed out here. For example, short-term loans, bank loans, or lines of credit for short-term working capital needs. Loans are available for a smooth functioning of business, no doubt, but it is the prime responsibility of every businesses just to have such kinds of policies and practices for the sound working capital management. So if there are any kinds of deficiencies are there for the smooth functioning of the business, so you can go for businesses can go for short-term loans where banks loan are available for short-term working capital needs. Factoring, selling account receivable to a factoring company for immediate cash. Commercial paper, short-term unsecured debts issued by corporation for working capital management. So when we're talking about these working capital management, businesses should be very clear in terms of their policies and practices for the smooth functioning of their businesses, for the smooth functioning of day-to-day capitals, day-to-day working capital. Optimizing working capitals, it involves the implementing strategies to improve the efficiency of current assets management and current liability management. This can be this can be achieved by way of reduced inventory level. Don't block your capital by unnecessary inventory. If capital is free, you can go for various kinds of business activities. So first point here means how to optimize the working capital, reduce the inventory level, implement lean manufacturing techniques and improve the forecasting to minimize excessive inventory, accelerate receivable collection, offer incentive for early payments and streamline the billing and collection process. If you want to increase your sales, have some kinds of unique points, some kinds of offers for the as far as the the account receivable is concerned. You need to what provide some kinds of, in order to get early payment, some kinds of offer discount, so you can get optimized working capital. Third point in optimizing working capital, negotiate payment terms. Extend the payment terms for payables and take advantages of early payment discounts. So by way of all these things, by way of all these 3 points, other than these two, maybe other point will be there. So you can maintain your working capital. You can optimize your working capital. So based on this working capital, we are just going to conclude this all because it was a very small topic. Means you in a nutshell, in a concluding remarks, you can say that the management of working capitals means how you're going to manage of uh, manage of these uh, inventory, manage of these creditors, manage of these account payable, manage of these account receivable. Means other than these, what the different liabilities and assets are there, you need to manage it effectively and soundly. So effective working capital is essential for businesses of all sizes. By carefully managing current assets and current liabilities, companies can ensure they have the resources to operate efficiently, invest in growth, and maximize profitability. It is crucial to understand the key concepts, apply best practices, and continuously monitoring, supervising, regulation, regularizing, and optimize working capital to achieve financial success. So working capital is what vital is a vital component of financial health, impacting profitability, growth, and liquidity. Efficiently, efficiently managing inventory, accounts payable, receivable is essential for optimizing working capital. Continuous monitoring and improvement are crucial for maintaining a healthy working capital position. So, in a nutshell, in a concluding remarks, you can say that working capital management is the most important, is the is the the it should be on on a first on priority basis, that you should to be in a very sound in terms of your policies, your practices, so we can achieve the overall objective of the businesses. So next we will as per the first lecture, I told you today we have to discuss two topics with you all. First, working capital management, and second was the capital structure, planning and analysis. So now understand first capital. It may be anything which is the assets of the company is known as the capital. So it may be in goods, it may be in cash, it may be in kind. So working capital or capital structure is what? Means how to make a strong planning, sound planning in order to uh, in accordance with the objective of the business. So capital structure is the mix of debt and equity, financing that a company used to fund its operations and growth. If we talk about only and only equity, own capitals, business can be run, no doubt, but you will not going to get lot of benefits. By involvement of this debt into your capital, the mix of debt and capital make your business flourish. Why? As per the Indian Income Tax Act 1961, the interest on capital, the interest on the uh, debt is allowed as a deduction. So you can get the benefit. And similarly, by introducing debt, the earning per capital EPS will also going to increase. So it is a fundamental aspect of the financial management, influencing a company's risk profile, profitability, and overall value. This in this lecture, this presentation will delve into the intricacies of capital structure, exploring its definitions, planning analysis, and strategies for optimal utilization. So now understand the definition of capital structure. What does it mean? This the debt financing. This involves borrowing money from external sources, typically banks, say commercial bank, lender bank, bank holders, or other lenders. It comes with interest, fixed interest, payment, and fixed maturity date. For example, bank loan, corporate bond, commercial papers. So these are the various modes of financing. The debt financing, banks, loan, commercial papers, and debenture, and many more way of financing debts. So we talk. This is what the capital structure. The combination of both two, debt as well as equity, is known as the capital structure. But each and every one have some kinds of merits as well as demerits. When we're talking about the equity finance, so these involve raising capitals by selling ownership shares in the companies to investors. Equity holder receive dividend based on the company's performance, and they have voting rights. Example includes common stock, preferred stock, and retained earnings. So the mix of both two is known as capital structure. Similarly, a sound planning and a sound policy toward the capital structure will flourish your business. So your business will be on boom. You will get the prosperity. So it's have a very vital role. Importance of capital structure. When we're talking about the importance of the capital structure planning, we mean first optimizing cost of capital. A well structured capital mix help minimize the overall cost of financing, maximizing profitability. So if you have the combination of debt and equity in appropriate way, means more debt, less equity, less debt, more equity, or balance 50-50. So you have a very good. capital structure. The first point, optimizing cost of capital. A well-structured capital mix helps minimize the overall cost, because on the equity we have to pay the only dividend, and in case of a preference share, once there will be profit, we will get the dividend. Otherwise, in case of equity, if no profit, no dividend. But what about the debt? You have to pay the interest. Either there will be any kind of profit or not. So managing the risk, the second important, the second vital concept, the second vital point in this capital structure planning, a balanced capital structure mitigate financial risk by distributing it between debt and equity finance, leading to a more stable financial position. Means there you need to manage the risk, and if there will be the balance between cash, between debt and equity, so it will be managing the risk. Boosting company's value. It means a strategic capital structure can enhance a company's value in the eyes of investor, leading to a higher market capitalization and better access to future financing. Similarly, flexibility and adaptability. It means a well-planned capital structure provides the flexibility to adjust to change market conditions and size growth opportunities. So this is what the various importance of the capital structure plan. There are number of factors. There are plenty of the factors are affecting your capital structure decision. When we wanted to expand your business, when you wanted to short your business, when you wanted to have a strong control your business, when you wanted to take they are planning to introduce more and more additional capital as equity, as a debt. So it's have some kinds of merits and demerits. You can't blindly take the decision. In business, every decision have importance, and the decision always going to take on the basis of fact and figure, not in air and vacuum. So what are the points you should to keep in mind, right? Factor influencing capital structure decision. The first point is the most important, which is industry characteristics. Companies in the industries with high growth potential or volatile earnings may favor equity financing, while those who are having with stable cash flow and low risk may opt for more debt. Means the company having more volatile in earning always favor to equity, but those who are having more less low risk and stable cash flow, they prefer for debt financing. So the most important is what the factor influencing is industry characteristic. Similarly, other factor which have also impact on capital structure decision, company size and stage. If talk about startup, smaller, younger companies often rely more heavily on equity due to limited credit history and high risk. Startup today, we talk about the startup. Everybody talking about the startup ventures, your own business. Bank generally does not provide credits to such kinds of startup. Why? Because they don't have any kinds of past track record of paying the debt. So here, company size and stage is a matter of the discussion also for the capital structure decision. If there will be there, this if the size of the business is small and younger, it is more they will prefer more equity compared to debt. Established companies have greater access to debt financing. For example, Reliance, Tata, Adani, Aramco. These are the companies are well established. Banks are always ready to finance them on a single call. So company size and stage is also a matter of the discussion, also a factor of influencing capital structure decision. Then we talk about the financial performance. A company with a strong financial performance track record and low debt levels enjoy greater flexibility and can leverage debt more effectively. while companies with weak performance may be limited to equity financing. If the firms of the soundness, if a company have a very sound financial health, so they will always get the advantages of debt, leverage debt more effectively, while the company with a low track record of finance, right, limited to equity finance. So these are the few points which to keep in mind while capital structure decision. So these are the factors influencing capital structure decision, right, which is very important. Debt financing sources and consideration. There are a number of sources of finance are available in the market. Every source have some merits and demerits. Few has been identified when we're talking about the debt financing. Bank loan, traditional loans from the bank are often secured by the assets of the company. Interest rates you have to take into account. Loan convenience, maturity dates you need to pay once it is due. Bond, if you talk about the second debt financing bond, security is used by the companies to raise debt capital. But point is to keep in mind interest rates, bond rating, maturity date. If you talk about the commercial paper debt as a debt financing, short-term unsecured debt issued by the companies with strong credit rating. It also bears interest rate, liquidity, maturity. If you if you go through these all kinds of debt financing, you will always come to know one point is common in every finance, in every types of debt finance. Interest is a matter of the discussion in business. Why interest is a matter of the discussion? Because most of it is a very it is a you have to pay compulsory. You can't skip these liabilities. Today or tomorrow you have to pay. But similarly, you are going to get also the advantages of the debt financing. Similarly, equity financing is also there. As I told you, capital structure is what the mix of debt and equity. So first and most important, equity financing is the common stock. It means the basic ownership in a company with voting rights and the potential for dividends, but subject to market fluctuation. Once you own the equity share of the company, you will get by virtue of law the voting rights and the potentialities for the dividends. You can partake in the AGM of the company because you are the real owner of the company. You have hold equity. Similarly, the second debt equity financing, which is what preferred stock, hybrid security with features of both debt and equity. It means offering priority in dividends and potential for appreciation, but often with often with limited voting rights. If you hold equity share, it does not. If you hold preference share, it does not guarantee that you will be the having the voting right because it is what limited. So the second is what preferred stock. Similarly, retained earning, the third and most important equity financing is retained earning. What does it mean, retained earning? Now understand. Profit that a company keeps for reinvestment rather than distributing as a dividend, contributing to equity financing and enhancing growth potential. Profit that companies have generated by way of their various activities, it should be retained with the business. It should not be distributed as a dividend. It should not be distributed as the invest as a what interest. It should be always keeping in the business. So this is what called retained earning. So these all are the various equity financing it's have made as well as demerit too. Similarly, when we talk about the optimum capital structure, balancing risk and return, you should keep in mind risk factors too associated with every businesses. So, debt financing. Higher debt level can lead to lower cost of capital due to tax benefits. As I told you, As per the Indian Income Tax Act 1961, the interest on capital, the interest on debt is what allowed as a reduction. So debt financing, cost of capital will be low if you're going to mix a higher level, a higher debt and lower cost of capital debt compared to the equity. It will also increase financial risk, no doubt, due to interest payments and potential for bankruptcy. Once you mix the debt, it will raise few questions. What about the financial risk? What about the interest? What about the interest on these capital? Similarly, equity financing. When you talk about the equity financing, higher equity level provide financial stability and lower financial risk because it is your own capital. You haven't taken loan from the banks or any financial institutions, but it can dilute ownership and result in higher cost of capital due to need to share profit with the shareholder. Once in your company, equity, different player hold equity share. They got the equity, the voting rights. So it will what dilute the ownership and result in higher cost of capital. Similarly, optimum capital structure. So these represent the index of mixed debt and equity financing that minimizes the cost of capital while maintaining an acceptable level of financial risk. It is specific to each company and its unique circumstances. So capital structure analysis modeling, if you talk about these capital structure analysis, financial ratio and metric, debt to equity ratio, measure the proportion of debt financing to equity, financing, equity finance, indicating the company's leverage and its ability to handle debt obligations. Similarly, we have other financial ratio and metric times interest earned ratio. It means the company ability to recover interest payment on its debt using earning before interest and tax. So we means here that uh, just a minute. When we talk about the uh, return on equity (REO), it measures the profitability of a company's equity investment, reflecting the effectiveness of the capital structure and investment decision. Cash flow coverage ratio, it indicates the company's ability to generate enough cash to cover its debt obligation, including interest payment and principal repayments. In order to adjust the strategies for adjusting capital, as you know, businesses is full of risk. You need to be a very strong in terms of your decision, strong in terms of your policies, strong in terms of your strategies. So issuing new dates is the most important part. Issuing new dates, the most important thing. Companies can raise capital through issuing new bonds or obtaining loans to increase leverage and potentially lower the cost of the capital. Similarly, one of the most strategies repurchasing shares. Just buy back of your shares means companies can reduce equity financing by buying back their own shares, increasing leverage and potentiality, boosting earning per share. Similarly, the third strategy the company can adopt is issuing new equity. Company can raise capital through issuing new shares of stock to reduce leverage and potentiality, gain access to new investor and growth opportunities. And the last strategy the company can adopt, paying down debts. Companies can reduce debt by making early repayments or restructuring existing loans, lowering leverage and reducing interest expense. So these are the various strategies of the for adjusting capital structure. Similarly, based on this overall uh, lecture, now we have some concluding remarks, quick recap of what we have discussed. Just right now told you, capital structure, the mix of debt equity is the most important aspect of the business organization. So capital structure is an essential aspect of financial management that require a careful planning, analysis, and ongoing adjustment. By understanding the factor influencing capital structure decision, evaluating financial ratios and metrics, and implementing appropriate strategies, companies can achieve an optimum capital structure that balance risk and return. More involvement of more involvement of debt leads burden on the company. Similarly, more involvement of equity dilute the ownership. So there must be the balance. Balance of what? Balance of debt and equity. Maximizing profitability and support sustainable growth. Capital structure, remember, capital structure, remember, is not a static concept. It must be regularly reviewed and adjusted to reflect changing business conditions, market dynamics, and strategic goals. So keep in mind what we have discussed, the mix of both two, debt as less debt as less equity, is a matter of the discussion overall. So this was a short lecture on this capital structure planning and analysis. So if you have any kinds of doubt, questions, confusion, or anything else in your mind which is not yet clear to you, or you are getting some kinds of problems in order to understand the concept of this capital structure, capital versus working capital, so most welcome at any time. You may contact to me at 7618057190. My WhatsApp to 7618057190 is my WhatsApp number. Or you can also contact to me at my email, institutional email as well as personal email, jnasik4 at gmail.com, or you may also contact to me at jansari at rul.ac.in. So uh, as we have just right now discussed about the concept of working capital management, the management of the working capital structure, these all are the phenomena have a very vital role, have a very significant, have a very significant place in a business organization, because the success and failures is totally depend on the management of the business. Just as oxygen is required for the smooth functioning of the of the organs of our body, same way finance is also required for the smooth functioning of the business. So uh, what we have discussed is about the concept of business or financial matters of the company, working capital, capital structure. So based on overall things, a special thank goes to each and everyone, those who made this, lecture possible. Thanks from the express. I would like to express my deep gratitude from the top of my, from the down of my heart, to the listener of this video, to the listener, to for your time, for your patience, for your valuable insight. So thank you, the audience of these, with the audience of this lecture, for your valuable time, for your valuable, you know, listening. Thank you so much for everyone, especially the audience of this lecture, the students who are just right now listening this video. Thank you so much. Have a good day.